Hello and welcome, everyone. I'm Tom Bowley, Chief Market Strategist at earningsbeats.com, and this is Trading Places Live. It's Thursday, March 24th, 2022, and I'm pre-recording this Trading Places Live for a bit later this morning. Currently, futures are looking pretty good. This is after finally a down day. We've seen a lot of up days in recent sessions, but looking at a potential down day, looking at a potential rally today after yesterday's selling. Currently, we have futures. Looks like Dow futures are up about 163. S&P 500 futures up 28. NASDAQ futures up a little over 100. So on a percentage basis, NASDAQ rallying. Oil is down just a fraction, a little bit below $115 a barrel. Of course, we've seen that extremely volatile here over the past month or so. U.S. 10-year Treasury yield back up 5 basis points today to 2.37%. That'll be something to watch as we continue to see the 10-year Treasury yield move higher. And still very low, though, from a historical perspective. So we don't want to lose that perspective. I know it's higher than anything we've seen in a while. But if you study the history of the stock market's fine until we see a 10-year Treasury yield climb maybe up into that 5% area. So again, we've had a huge spike, and it's never good to see interest rates move up this quickly. But I think there's a lot of reaction going on to what the Fed had to say and their anticipated rate hikes in 2022. And so at this point, I don't think the market is overly spooked by it, but we'll see how things continue to evolve. All right, today, let's go through the agenda for today. We'll start off, as we always do, with the daily market recap, and we'll get into talking technically. Break it down. I'm going to take a look at the consumer discretionary group a little bit, take a little, just a little different twist on break it down today. Earnings spotlight, and then wrap up with the 3 you must see. Going to talk a little bit about resistance, price resistance, trendline resistance, gap resistance in going through those final 3 you must see. All right, before we get into any of that, let me take you over to earningsbeats.com. If you go to earningsbeats.com, scroll down. Love to have you. Always like to make sure everyone is aware that we have a free newsletter. It's our EB Digest, published 3 times a week, Mondays, Wednesdays, Fridays, normally out around 8:30 in the morning, so maybe about an hour before the market opens. It's a very quick read, normally just a couple of paragraphs and a chart. It's designed to be very educational, just teaching about the things that we feel are really important in technical analysis. We feature relative strength a lot, along with earnings, companies that have reported earnings showing the gaps, gap support, gap resistance. Candlesticks, another big area. May focus on volume if we think the volume is important to, that coincides with a particular move in one direction or the other. So all you have to do is go over to earningsbeats.com, scroll down, and you'll find this area. It just requires a name and email address. No credit card required. You can unsubscribe at any time. We'd love to have you. We had a huge free event last night, and we always reach out to anyone who is on the Earnings Beats Digest community and on this newsletter. We send out room instructions for our free event. So that's another reason to be on this list. Last night did a Q1 market update, talking about many of the things that I talked about at the beginning of the year that led me to say that I thought we were heading for a potential bear market, cyclical bear market, not secular. Cyclical meaning short term. And I still believe that. Technically, we haven't seen the S&P 500 drop yet, the 20% required to technically, quote unquote, have that bear market. But I think that there is a bear market that's already well underway in many areas of the market. So again, these are the types of events that you can be part of if you are a Earnings Beats Digest subscriber. All right, one other thing I want to get out of the way too. I don't normally talk about our paid membership, but we did start a special with that event last night with that webinar. We're going to have an event a special through Friday at midnight. So got another day or so, a little over a day to take a look, take advantage if you're interested. For those members that are out there who are already paying annual members, if you click on this, you'll see that we are now offering 13 months for the price of 12. So you get an extra bonus month through tomorrow at the end of the day. If you're new to earnings beats and you want to sign up for a free trial, sign up for your 30-day free trial and then take us up on this offer if you feel like it's going to be a service that will benefit you. And you end up getting 14 months. You'll get your 30-day free trial, plus then you'll get 13 months on top for that $9.97, which, by the way, is almost a 50% savings off of our monthly rate. So it does make sense to lock in if you like our service. Anyway, let's move on to the daily market recap. I'm going to start off with the Dow Jones, which was down 449 points yesterday. S&P 500 down 55, NASDAQ down 186. Mid caps down 49, small caps down 24. So everything was down more than 1%, but less than 2%. Still, after the rally, this was really the first sign of weakness that we've seen since last Monday. So we had gone up, I think, 6 straight days. And then yesterday was our first down day in a while. So that was something to try to digest, and we'll see what happens. Short term, you can see we've moved up through the 20-day moving average. I'd like to hold that on any further weakness. Normally, and I'm going to talk about this in just a minute, but normally once you get one of these down days like this in a downtrending market, you normally don't go back up to a new high. So that will be something to watch to see, because futures are up this morning. We'll have to see if we can break back out again above the highs that were set back on Tuesday. That would be a bullish development in the short term. And again, I'll show you in just a minute how that hasn't really happened in the past. So it's something that would be significant, I think, if we were to turn back up and go higher significantly today or tomorrow. Energy was the leader yesterday, up 1.7%. No shocker there. We are up against some key resistance now. Closed at just under 77. That was an area of closing resistance prior. So we want to kind of watch to see if energy breaks out. Utilities, 71.01, also getting up near this resistance area. They were up, utilities up just a fraction, 0.14%. But these were the only two groups that were higher yesterday, energy and utilities. To the downside, financials, healthcare, technology, all down between 1.5% and 2%. You can see the trend in financials down, so that looks like it's rolling over there. Healthcare had been doing pretty well, breaking above the highs that we saw back in February. But after breaking out, we're now going back. We're now testing the level of that high and then also that rising 20-day. So with healthcare, that's an area I would be watching maybe over the next $1.50 or so to the downside, be looking for a bottom. And then you've got technology. Technology, it was down 1.5%, but still hanging well above the 20-day moving average. This one's going to be the one, obviously, it's going to have the biggest impact in the market. It's the highest weighted sector in the S&P 500. And so, depending on which way technology goes here, do we get that definitive breakout above the 50, or do we go right back down and test the 20? And potentially it would be a bad sign, I think, if we go back and close below the 20. So I'd be keeping all of that in mind. 10-year Treasury yield, as I mentioned earlier, we got the 10-year Treasury yield up 5 basis points. It's not showing here at this point on the StockCharts chart. I think that'll be showing probably in the next half hour or so. But anyway, right now we are seeing, let me get an update, make sure that's still the same, because it can fluctuate. Yeah, we are still up 5 basis points, 2.37%. So we are getting back up here close to the high. We did see test of the 240 level last couple of days, 237 this morning. We'll see whether or not we can break back through there. The uptrend clearly is in play here until proven otherwise. So it does look like yields probably are going to move higher. But the rising 20-day that we broke out here about 2.06%. And now we've got the rising 20-day sitting at 209. So that's going to be an area, if we do fall back, that we would want to watch to the downside. All right. Economic news out today. Actually, one thing I wanted to mention yesterday, February new home sales. The expectation was 810,000. The actual 772,000, almost a 5% miss on new home sales. And the January numbers were revised lower. So it was not a good report for home sales. And we'll take a look at those home builders in just a minute. Not a good look there as well. Later this morning, we're going to have initial jobless claims out. Last week, 214,000. Estimate for this week, 210,000. So we're looking for a little decline there. February durable goods January rose 1.6%. February expected to decline 0.5%. That's not unusual. Durable goods tends to be very volatile. If you were looking at this and wanted to try and get a real sense of durable goods, I would take maybe a 3, 4, 5, even 6 month moving average because of the volatility in here. February durable goods, if we strip out the transports, expected to rise 0.5%, whereas January rose 0.7%. So both are expected to drop, but much more noticeable on the headline durable goods number. March PMI composite, manufacturing is expected to come in at 56.6, services 56.0. Big thing to note there is in February, both of those numbers jumped quite a bit, and it was because the COVID cases were coming down. So we got some really good readings there in February on both those, but we are expecting slightly lower readings in March. Manufacturing 56.6, in February is 57.3. Services expected to be 56 in March, and in February 56.5. So we are expecting slight pullbacks there. I also want to mention that Friday, tomorrow, March consumer sentiment will be out, the final reading. We get 2 of those a month. We get a preliminary and we get a final. So the preliminary earlier in the month was 59.7. We're expecting that to come in the same in the final. The reason I bring up consumer sentiment, I think it's a pretty big number, because if you go back and you look at the last couple of recessions, they've both been predicted by a rapidly declining consumer sentiment number. So when consumer sentiment's dropping, it is noteworthy and many times is a predictor of a recession. And everything we've got going on right now with the much higher crude oil prices that's hitting everybody at the pump, then you look at what's going on in terms of the interest rates, what the Fed's talking about doing, raising rates 9 times this year and potentially 12 between now and 2023. That's going to cut into pocketbooks of the consumer. So we've already got signs with the consumer sentiment readings dropping the last almost year. And now we've got some other signals that could point to that as well, including that new home sales number yesterday. Let's talk about that here for, well, in a minute. Let's look first at the S&P 500, then I'll bring up. So talking technically, I want to look at the S&P. You can see now we had 6 straight days of higher highs and higher lows. And then yesterday we had a slight reversal. Nothing horrible in terms of technically, not losing any major moving averages. You're not going to go up every day. So pullbacks are normal in an uptrend. The question is this a pullback in this uptrend, or is this the start of another leg lower? That's the question. And when you get into a secular bear market and you get these bear market rallies, notice the one that ended at the beginning of February. 4 nice hollow days, 4 days in a row, higher highs, higher lows. We had this one down day. We ended up coming back up, but we never broke out again. So we had this down day, couldn't get back through the high, and then down we went. The next couple of days, you can see the rally. We got pulled back slightly higher, but not a close above the 20, not a close above that high, and then back down again, basically for a double bottom. Now we've got this rally. I mean, I think there are some positives in this rally. I think getting back through the 20 and the 50, both technical positives, that beats the alternative, right? Going up to the 20 and then turning and going to new lows. So that does give us a little bit a better technical picture, at least in the short term. But I think we're range bound right now. I believe the key to this chart is up near 4,600 on the S&P, where we have this double top, lower low, lower high, lower low. We never took out this lower low. So right now that lower high is the one that kind of keeps us grounded from a more bearish perspective anyway. So this level is a level that from a bearish perspective, you want to see hold. You don't want to see a breakout. From a bullish perspective, to me, that changes the look of this chart from a downtrending chart to maybe one of sideways consolidation. Maybe I would say at that point, we've probably bottomed, and it's more sideways consolidation, maybe through the next couple months or even through the summer. But if we don't get through 4,600, I would then be looking to the rising 20-day and this price support area at 4,400. If they both give way, then at that point, I think we're in trouble to the downside. So that's what I would be watching. I mean, we could go back, look at this rally. This was back when the market was still healthy. Look at us go up, up, up. And you see that red candle looks kind of similar to that one. We pulled back and the volume even picked up a little bit. And so you might have said, well, that's it. Not going to, that was the top. Well, look, we went right back up again. So the bullish conclusion to yesterday's candle would be simply to ignore it and go right back up to new highs, ultimately taking out 4,600. That's the bullish slant on this, or holding the rising 20-day and going up and taking out 4,600. Either one works. But we'll see whether or not that short-term weakness from yesterday continues today. Looks like with futures, we'll at least get off to a good start. Look at the, watch the 10-minute 5-day chart, because if we get this move back up to yesterday's high was 45.01. So it wouldn't be unusual to see a gap up. Maybe we get gap up to 44.80, 44.90, and then turn right back around and sell off. Because in an uptrend, a lot of times when we do see the morning weakness or weakness intraday, we tend to see rallies. We don't take out that prior day's low, and then we just rally right back off of it. Well, on a downtrend, the opposite normally holds true. So as you start the downtrend, sometimes you'll see morning strength, but if you don't clear the prior day's high, a lot of times by the end of the day, you close weak. And if we do that today, that would not be a good look to the chart. So morning strength followed by a close on the lows again and a new low would not be what you want to see as a bull. False move to the upside in the morning, followed by afternoon weakness. That's normally a sign of weakness for the chart. So just be careful with that. All right, I wanted to talk a little bit about the home builders, because new home sales came out yesterday, well below expectations. Again, it's supposed to be 810,000, came in 772,000. Look at the reaction there. The group dropped another 4%. And after stabilizing and going sideways, here we had a positive divergence. I mean, as we were moving lower, you can see this low, about an equal low here, and then the lows were getting higher as we went back down and tested it. So I'd view that as a positive, a slight positive divergence. We got back up close to the 50-day to reset, got fairly close to the center line, didn't quite get there. But notice we did not get through the reaction high. So at this point, I mean, the home builders need to get back through about 1410, 1415 to start repairing the chart damage. We got a long way to go. We got probably 10% just to get back to that resistance level. And we're not far from breaking down again. Look at the bottom of this chart. This is home builders relative to the S&P 500. We're not breaking down on an absolute basis, but look at the relative weakness, breaking to a new 52-week low yesterday. We're adding to the existing 52-week relative low. So this does not look like a very good chart. And I think we need to be really careful, not only with the home builders, but this is just another sign. I mean, this is in the consumer discretionary area. If consumer discretionary is weak, it's really hard for the market to pick up the pieces and move forward. We need to see strength in consumer discretionary. So I thought what we do today for break it down is let's take a look at the XLY. We got this move up. We took out this prior high. I think this is the big high here. You can see the support right around 190 in the bounce, went back up, couldn't break out. Then we went through 190 to the downside. Look at all this volume accumulating or accompanying it. And then look where we rebounded to, from 172 back to 190. Right here at 190, and failed. You can see the volume on the way back up was lighter, and then we start rolling back over with heavier volume, and we went back down to new lows. We do have, basically a double bottom in. We've come back up. I think the key is to get back through this 190 level. We're not quite there. Closed on the low yesterday, but we do have this trend now of 7 straight days? 1, 2, 3, 4, 5, 6, 7. 7 straight days of higher highs and higher lows. So even though we finished weak yesterday, we do still have this streak intact. Futures are up today. If we can get a breakout on the XLY and make a run for 190, that would be great. A breakout above 190 would be awesome, because this is one of the key areas of the market. So you want to start seeing leadership here. Now, the downside that I would say, you got lower lows coming in here, higher PPO, positive divergence. We've made that move now. Look, we're all the way back to the center line. This is a reset. Momentum at this point on the XLY is 0. Some might look at this and say, yeah, but it's pointing up. It's moving up. That's good. That's bullish momentum. Not to me. To me, bullish momentum is above 0 in rising. So getting back to the 0 line your 12 period moving average and 26 period moving average are equal. That's basically what this is telling you. So there's no real momentum. It's just what this is slowing selling momentum. And when you're below zero, you've got selling momentum, bearish momentum, whatever you want to call it. Upside is more bullish momentum when you're above zero. So a lot of people get excited about a rising PPO under the center line. I don't. I mean, normally what that tells me is just, I mean, look at this. We cross over. Some people use this trigger line as a reason to get in. Well, we were crossing over this trigger line pretty close to when we were at our high. Had one more slight little high. It looked really good here. If you're a fan of rising PPO lines below the center line, looked really good there. Look what happened. What did that get you? I like my PPO to be above the center line. That is when I feel like I can trust a pullback. Otherwise, when you're below the center line, a lot of times a pullback is a new leg lower. It's not a pullback. So anyway, watching the center line, watching where we are, nice rally. This has been great for the last week or so. A lot of it may have been options related last week, so please be careful about that. I think the key now is whether or not we hold these rising 20 days. So that's what I'm going to look for on the XLY. Down here at the bottom, this is the XLY versus the XLP. Now, I can tell you one thing that I really do like, and this is more intermediate term than it is today, but I like the fact that this downtrend channel that we've been in, I mean, if you connect these highs right there and you drag this line right over here, I mean, we've kind of had this channel that we've been, just continuing to meander lower and lower. Well, we broke out of it with this move to the upside. So in addition to finally getting through the 20, finally getting through the 50-day moving average, we also have, a break of the channel. Now, it doesn't mean that we're going straight up. I think there's key resistance, relative resistance right here. So you got lower low, lower high, lower low, lower high, lower low. And now we're bouncing back trying to take out this reaction high. So we're not out of the woods. But what might happen is if we do go back down one more time, what we might see is that this relative strength of discretionary versus staples may hold this prior low. So what we might see is a breakdown in price, but holding relative price action. That would be an important piece of technical evidence that perhaps we're getting close to a bottom. So something really interesting to watch. As far as the S&P 500, this is what I was talking about. If we roll over and go back below these lows, and this relative strength line goes down but does not take out this low, that would be a potentially bullish signal for us. Something to keep in mind if we do weaken again. All right. So let's quickly, I want to go through these charts and just show you the problem that we have with consumer discretionary. So this is the relative strength of each industry group within consumer discretionary relative to the S&P 500. And this is a 3-year weekly chart. So if you're going up for a while, this is months, not weeks or days. This is since August of last year. Hotels have actually done pretty well. Now we're getting back up to this area of resistance where we broke down during the pandemic, and we are looking maybe to roll over. So just be a little cautious here, but that one's not looking bad. Toys been in a downtrend for over a year. Got to be careful. It's rolling back over again below its 20, which is below its 50. Relative PPO in negative territory, not good. Restaurants. A lot of folks think, well, COVID's done. Everybody's going to be coming back out and doing all these things. Well, why would restaurants be going down then on a relative basis? Wall Street looks ahead. This to me is a really bearish signal. What this is telling me is that my theory of a potential recession ahead, I think that's what's getting built in right here. Why else would restaurants be going down in an environment where COVID virus is basically disappearing here in the US? Doesn't make any sense. The only thing that makes sense is recession. And consumer discretionary, if you look at, I'm going to go through all these really quickly. Here we go. Specialized consumer services. I want you to just look at the downslope in all these. Clothing and accessories. Home improvements, back down near a 1-year low. Recreational services, never really, after the huge steep decline back here in the pandemic, never really rebounding from that. Apparel retail. Look at that. Wow. How about specialty retail? Down at 3-year low. Travel and tourism just set a 3-year low on a relative basis. Travel and tourism, think about that with COVID. Everybody's pointing to things opening up and everything's going to be much better travel. Why are we at a 3-year relative low on travel versus the S&P 500? Probably because we could be looking at a global recession. Gambling, new low, 3. Why, casinos and all, they're going to be opening up. Why would they be going down? I say recession. Home builders, we just talked about those. Home construction, testing this low from early 2021. Broadline retail actually bouncing back. And I'll tell you, the reason that the overall consumer discretionary is not doing that bad, partly is because broadline retail, think Amazon. Amazon's been doing pretty well of late. Here you go, furnishings going down. I'm going to show you another one that's helping the XLY right now in just a second. Footwear getting hit. Business training and employment agencies potentially, think about that group potentially moving to a 1-year low. Why would this group be moving down? Recession. How about durable household products? Awful. Here's the other group that's good. Automobiles, Tesla. Tesla and Amazon right now are holding up the XLY, which isn't necessarily a bad thing, just pointing it out because it's a fact. Those two are by far the largest holdings of the XLY. So if Tesla and Amazon roll over, there's nothing else that really looks good in this area. Look, there's recreational products, there's auto parts, and then we move on to communication services. But it's not a good look to the market or to the charts and to that whole area. All right, let's move on to earnings spotlight. Just real quick, not a whole lot of big companies. I did want to point out that trip.com or ctrip.com rallying here heading into its earnings report. It did beat its estimates, up 7%. So it looks like it's going to get off to a pretty good start. One other one that I'll mention is KB Home. Since we were talking about the home builders, they missed 147 versus 152. The stock's down 4% pre-market. Watch the 34 level. The stock needs to hold 34. All right, the 3 you must see. I wanted to go through and show you these real quick. First one up is Edwards Life Sciences. Do you see on this move right here, the reaction high coming back up, getting up to about 114, pull back to 108, move back up to 114, pull back to 103, move up to 114, pull back to 101, move back to 114. Do you see the common theme? 114. That is resistance. Good news with this stock is I love the AD line. So if we get a breakout, this is a stock in the healthcare area that I think could be a good stock. So watch for a breakout above 114. Next up, TFX. This is Teleflex. Same thing, maybe on a lesser basis, but we go up, we set our high at 350, hit the 20-day, we bounce off of it, beautiful, get back up to 350. Short-term trader takes profits there, waits to see if we get the breakout. AD line here doesn't look nearly as good as that stock I just showed you, EW. So this one doesn't look nearly as good. We've fallen, broken down below recent support. I just wanted to show you this one, to me, looks worse than EW. And then the last one I have for you is QB, Customers Bancorp. And here you've got this gap, this move down on heavier volume. Gap resistance around 62, top, bottom of gap resistance 58. 50-day moving average coming in at 60.5. That's all resistance. We went right up to 60 and started to roll back over. You want to be careful with a stock like this. All right, that's it for me. My last show of the week. I'll be back on Monday of next week for your next Trading Places Live. You can go over to earningsbeats.com and click on, actually, if you go over to earningsbeats.com and then just click on this Trading Places Live after 8:45 in the morning. So in the 15 minutes leading up to the show, you'll be able to come right into to our show. So I'd love to have you. Anyhow, that's it for me. Everybody have a great rest of your week. Be careful out there. Tough market. Happy trading, everybody.
Hey, Grayson Rose here with StockCharts. Thank you so much for watching. I hope you enjoyed that video. If you did, consider giving it a like down below, maybe leave us a comment, and if you're new to the channel, you can subscribe at the link up above. We're gonna bring you daily content from an incredible collection of technical analysts and financial experts.